The Bank of Japan just got a massive weapon, and almost no one is talking about it. The current account surplus hit a record high in March. That means Tokyo has more firepower than ever to defend the yen. And right now, US dollar to Japanese yen is sitting at 157.78, grinding into the same resistance zone that triggered intervention scare last month. There is one danger zone and one hidden opportunity today. I will show you both. Stay until the end because I am giving you 3 exact entry and exit levels you can use before the next session opens. Instant market verdict. The bias on US dollar to Japanese yen is bullish on every single time frame. Daily is trending higher. 5-hour is trending higher. But here is the catch. The momentum is fading. And the fundamental landscape just shifted under the surface. The one invalidation level that proves the bias wrong is 156.79. Write that number down. If we break below 156.79 today, the entire bullish structure starts to unravel. Until then, bulls have control, but they are walking on intervention glass. Let us go deep into the chart. Start with the daily. Price is trading well above the 200 moving average, which sits way down near 148. That tells you the trend is mature, not fresh. The 20-day moving average is at 156.20, acting as dynamic support. On the 4-hour chart, price has printed 3 consecutive lower highs while holding above higher lows. That is a textbook coil. The 60-minute chart shows MACD rolling over from overbought territory. Momentum is slowing. The bulls are pushing against 157.94 and 158.21, but every attack gets absorbed. Meanwhile, support is stacked at 157.23, then 156.79. This is not a clean breakout setup. This is a pressure cooker. Now weave in the cross-asset link. The Nikkei 225 has been rallying hard, which typically supports a weaker yen because risk appetite flows out of safe havens. But here is what most traders miss. When the Nikkei rallies on the back of a weak yen, the political pressure on the BOJ to act increases exponentially. The intervention ghost is not a joke. Every time US dollar to Japanese yen approaches 158, the verbal intervention escalates. And now, with a record current account surplus, Japan has actual firepower. They can sell dollars from their own reserves without breaking a sweat. The market is pricing fear, not just yield differentials. Fundamentally, the 24-hour core news is the record high current account surplus for March. That is a massive structural tailwind for the yen. It means Japan earns more from abroad than it pays out. That surplus can be used to buy yen directly. Meanwhile, the US dollar index is showing cracks. The S&P 500 is holding up, but breadth is narrowing. The 1 to 2 week directional lean is that US dollar to Japanese yen either explodes above 158.21 on a weaker US jobs print, or it collapses back toward 156.79 on a single BOJ comment. The exact event that invalidates the bullish thesis is any official from Japan using the phrase readiness to act decisively. That is the trigger most. People will skip this next part, but this is where money is made. Keep watching. Strategy 1. The sniper. Conservative. Trigger condition is a pullback to 157.23 with a clear rejection on the 15-minute chart. You want to see a bullish engulfing candle or a hammer right at that level. Entry at 157.25. Stop loss at 156.75, just below the second support. Target 1 is 157.90. Target 2 is 158.15. Risk reward is approximately 1 to 3. What voids the setup is if price closes a full 15-minute candle below 156.79. That turns the structure bearish. Strategy 2. The active trader. Standard. Entry condition is a confirmed break above 157.94 with a retest. You wait for price to clear resistance, pull back to 157.85, then reassert momentum. Entry at 157.90. Stop loss at 157.40. Target 1 is 158.50. Target 2 is 159.00 with a trailing stop move to break-even after Target 1 is hit. This trade only works if the Nikkei is positive at the same time, validating the risk on move. Let us see how aligned we are. Type your US dollar to Japanese yen resistance for tomorrow in the comments now. I am reading every single one. Strategy 3. The aggressor, high risk. This is the counter-trend intervention play. You short US dollar to Japanese yen on a spike above 158.10 without any follow-through. Entry only if price touches 158.15 and immediately prints a 15-minute bearish reversal candle. Stop loss tight at 158.45. Target 1 is 157.50. Target 2 is 157.00. Explicit warning. Only for those who know how to lose small and manage risk aggressively. The moment a BOJ official speaks, this trade becomes a lottery ticket, risk management pulse. Never risk more than 1 to 2% per trade on US dollar to Japanese yen, especially near psychological levels like 158. Stops are non-negotiable, and do not hold through high-impact news or intervention risk windows, close and retention loop. The single most critical level for the next session is 157.23. If that holds, bulls reload. If it breaks, the intervention ghost becomes real. Tomorrow, we focus on the Nikkei divergence and whether the S&P 500 can keep pulling Bitcoin and yen pairs higher. If you want the full breakdown on why gold and oil are flashing opposite inflation signals, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 assets. I will see you in the next one.